In today's class, we're going to talk about MBS, mortgage-backed securities. And it's a very hotly discussed topic during 2007-2008 crisis. And a lot of people are talking about it as referring to it as a toxic, the toxic asset, which is kind of funny because the asset has been set up this way for quite a few years, actually more than 30 years by the time of 2007, 2008. But when people are talking about it, it sounds like everybody was all of a sudden waking up to how bad it is. But down the road, risk management is there in every single aspect of the finance. So whatever security you are using, trading, there is a part of the risk management. So you really cannot say that, because I'm using this particular security, that's why it wound up making the whole situation so bad. No, of course, people got creative in creating all sorts of different securities. So risk management will be even more important. But in today's class, what we're trying to do is we're trying to get a little bit of a basic understanding of how it works. In particular, since we all understand conceptually that the MBS is mortgage-backed securities, these securities are collateralized with a pool of mortgages. Right, so in order to understand how these securities work, well, we first, of course, need to understand the mortgages, which I think that we have already tackled that task in financial management. But then we also need to understand how does the pool of mortgage work. Because once you have a pool, it's not individual mortgage anymore, so the behavior of that is a lot different. Okay, so on top of that, we then are going to move on to the mortgage-backed securities and look at a very kind of basic example and see how it works and how are the calculations done. And that's all the tasks that we're going to do today. So let's come back and have a quick review of the mortgage mathematics. So here, when we're looking at mortgage mathematics, everything looks so unfamiliar, if you will. Don't you think? And things are looking so unfamiliar. Why? Because in our classes, we never require you to have such a long formula. When we know the loan amount, if we want to know the payment, want to calculate the payment, what do? We always just rely on the time value of money line on the calculator, right? So specifically, we can just say that, if we have a loan amount of 100,000, that means the present value is 100,000, right? And then of course it's a monthly payment, and suppose it's a 30 year, so it's gonna be 30 times 12 equal to 360 periods. And then we'll put in the discount rate, the interest rate, whatever it is, the interest rate Y. In this case, we call it Y, right? And then the payment, we want to ask what is the payment, and then we have the future value. And here, what is the future value for a mortgage payment? Anybody? Zero, exactly. Because this future value basically tells us what is the lump sum of the payment at the end of the investment horizon. Right, so basically future value here, at the end of it, we do not have any big lump sum to pay in addition to the payment. Of course, we do have the last payment to pay. However, that payment is already included in the whole series of coupon payments or the fixed payments along the way, the mortgage payments. But in addition to that, there is no other lump sum to pay. So future value here is going to be zero. So So here, if we take a look at the example, it's going the other way around, and specifically it is using a factor multiplying by the payment, right, to be the loan amount. And basically the idea is I'm going to distill whatever that formula is. I'm going to distill it into the form of a payment times a factor, which is equal to the loan amount. Right here, we also assume a flat yield curve at y. What does that mean? What does it mean by a flat yield curve? First of all, what is a yield curve? A yield curve would be the picture of all yield at different terms, right? So if we're talking about current yield curve, then of course we have a picture of all the possible yields in the market. And by now, we have already known this very well. But what does it mean by a flat yield curve? A absolutely flat yield curve means that all of these, in all of these different terms, the interest rate is the same exactly. You're using the same discount rate regardless of whatever term it is. Right, so we're assuming the same old assumption that we always have been assuming in the financial calculator, the timeline function, where we assume the same discount rate as the IY all the way through. Okay, so if we distill that, of course, the loan amount can be a factor somehow made of all the different yields, a function of yields, but also it can be proportional to its payment. That's understandable, right? Because you would rationally think that if I borrow 100,000, then I would have half of a payment compared to if I borrow 200,000. So the loan amount and the payment should be proportional, whereas all the other factors is another function. Okay, so what is that function? Well, the function is basically sum of the discount rate. And if we take a look at the left term, it makes perfect sense, which is equal to 1 plus y divided by 12, because y is an annualized rate, divided by 12 is monthly rate, and then you discount the payment for whatever necessary period it has to be, then you sum over. It's just like a Macaulay duration, makes perfect conceptual sense, but it's not perfectly easy to calculate, because if you sum over there, what is capital N? Capital N here is 360. If you manually do it, you will have to sum up over 360 terms. So we would rather use the mathematical formula for for equal ratio, equal proportional Q, to make it the summation of that, and that is from a ready-made ready-made math formula. Okay, so that's how we solve it here. So here within this formula, we can easily solve the loan amount given the x, or given the loan amount solving for x, or given the loan amount and x, it is possible to solve for y, although it's not that easy, right? So we can see that it has a term that has y up to the power of capital N. So, but typically we don't go that crazy. So again, as we've shown in the previous slide, given x, the payment, and the loan amount, we can find the y, we can find the yield, of course, or given yield and loan amount, we can find x. And then you could simplify the whole function by using financial calculator. That's perfectly fine. Right, so then we can decompose the payment. Remember what we do in the financial management, whenever we calculate the payment for a mortgage, we always decompose it into the interest payment and the principal payment. This is very important. Why? Because in the mortgage world, it's possible to prepay. It's possible to prepay. So you need to figure out what is the fixed payment. You need to figure out what is the interest payment, and then anything above interest payment is going to pay down your balance outstanding. So a lot of times it's very useful to actually separate the interest part and the principal payment part. Right, so the interest payment part is calculated based on BN, the balance outstanding in one period before, right? So at n+1 period, the balance outstanding will be the balance outstanding. We're going to use the balance outstanding at period n in order to calculate the next period interest payment. Then the rest part of the payment is the principal component, right? So we have whatever payment it is minus this part is the interest payment part of the fixed mortgage payment, right? So coming back to the previous example, we have balance outstanding at the very beginning. The loan balance is 100,000. At the end of month 1, we have 100,000 times 6%, assuming that the yield Y is 6%, and divided by 12, it is going to be $500. So in the first month, you're going to be paying $500 for the interest payment. And what is your total payment? Total payment is almost $600. So $599.55. The difference between $599.55 minus 500 then is 99.55. This part is the principal payment. Okay, so that is a quick review. That's a very quick review of what we previously learned about mortgages, which is not horribly hard. As the time move on from the payment month 1, 2, 3 up to until 360, the principal payment will go higher and higher because the interest payment will go lower and lower. Right? So you have a fixed mortgage payment, but as the time move on, as more principal outstanding has been paid down, more of the principal has been paid down, the interest payment for each period is lower and lower, and therefore the principal payment component within the fixed payment will be higher and higher. Also need to isolate and have a little bit in detailed discussion here is the prepayment option. Prepayment option is very special to mortgages. It's not available, well, it is available, but it's not readily automatically available in many of the other bond structure. So if you think about a prepayment, what does it mean? Prepayment basically says that the investor the borrower of that loan, of that mortgage, is able to pay back whatever he or she borrows ahead of time, ahead of his schedule, right? So as long as he or she feel like it. But a lot of times this is allowed without penalty. In some countries, however, there are some contracts that doesn't allow you to do this. But here in the US, in general, this is allowed without penalty. So what kind of option is it similar to? The prepayment option, if you think about it, is really close to the call option. Because the call option, remember, is the right of the issuer, right? Who's the issuer? The issuer is the borrower of the bond, right? So whatever the company is issuing or whatever entity is issuing that bond, they are issuing the bond to finance, namely to borrow money from the bondholder. So here, if we kind of make the analogy to the mortgage world, then the issuer becomes the borrower, in our sense, the mortgage borrower, and the bondholder in this sense, in the mortgage sense, become the lender or the banks who are lending to the mortgage borrower. Does that make sense? So when the borrower actually have the right, the right or the prepayment option to pay it back early, it's as if the issuers of the bond is having the right to call back the bond early. So basically, they have the right to redeem the bond early. So similar to the call option, except for here in the prepay, you may or may not necessarily, pay down the whole balance at once, right? A lot of people choose to prepay a little bit at a time, and in general accelerate their payment schedule. But sometimes there are still situations where these prepayments happens when everything is paid down. Can you think about some situations where all the outstanding balance is paid down? Can you think about some cases when, I should really put it in here. Can you think about some cases when the whole balance is paid down at once? Maturity bond, but if you wait until the maturity of the bond, then it is not going to be a prepay. It's a regular scheduled payment, right? So in a prepay means that you pay it ahead of the schedule. And when will that happen? We're not talking about callable bond. We're talking about mortgages. When does that prepayment happen for mortgages? Well, default, yeah. Default can lead to that. Refinance, that is the most popular ones. So a lot of people actually, instead of direct deposit, what do you mean by direct deposit? Yeah, you pay off the whole loan. So in general, it could be default, it could be refinance, or it could be a refinance that is, it can be paid down because of house sale. So several cases, right? So default, house sale. So what happens at the default? For most of the mortgage contracts, it states that as a part of the note, part of the borrowing and lending contract, it says that if you default on anything, then the whole payment is accelerated. Acceleration in case of default. Here, what does acceleration mean? It is accelerated means that you have to pay down the whole thing right now, right at this moment. So everything is accelerated to upfront. Why? Because once you have one default, then your risk, your credit risk is not the same as before. Does that make sense? So when I lend it to you at this particular interest rate, say I'm lending it to you at 5.35%, that's based on your historical record, your credit score, and all of those. And I estimated that the probability and the risk, the credit risk, the probability of you defaulting is so and so amount. And that's why I gave you this particular interest rate, 5.35. However, once you have one first default action, that means the probability of following defaulting action will increase dramatically. Therefore, your credit risk is not the same. So I'm not willing to lend it to you at that particular rate anymore. So you need to repay back everything to me right now, right here. Okay, so that is default. And this default does not necessarily means skipping of payment. We're talking about any kind of default, which means it can be any kind of violation of the contract. So for example, if the contract says you have to buy house insurance, homeowner insurance every single year, and you did not do that, you skipped half of a year, you skipped 1 year, and then the mortgage company get to know about it and say, hey, that is a default. That's a violation of your contract. They could legitimately ask you to pay back everything at that moment. Okay, so it could be that they're giving you a hard time, but most of the time for those kind of problem, they'll work with you because the cost of having you accelerate everything and going through all the legal process, they wind up not getting what they wanted, and a lot of time they're willing to be a little bit lenient on that, but nonetheless, all of those clauses are written on the contract, right? Whether they want to be lenient and how they want to be lenient and work with you is another story. We expand that in the course of real estate. But then default on any part of a contract, including, for example, not patching a hole in your roof, or violating the tax, violating, not following the escrow, and not, buying insurance, all of those will result in an acceleration of in case of default. Okay, those can have a result of paying down everything. And we could, of course, default also leads to other consequences. Those details we're going to refer to real estate class. Refinance is the second most popular one, right? So a lot of people are thinking about it in the current situation right now. Interest rate is going to be low for probably quite a few more years with the unlimited QE, and who knows what was going to happen. So at least the short-term rate is going to be extremely low, but the long-term rate we will see. The refinance happens when the market actually have an interest rate dip. Right, so it was, say, 6%. Now the market prevalent rate, it becomes 3.5. Then a lot of people start refinancing. When they refinance, they are basically borrowing a new mortgage to pay down the old mortgage, and that will pay down the old mortgage 100%. Okay, so for the old mortgage, this is 100% pay down prepayment. And then we have the house sale. House sale is also another situation that has an acceleration. Most of the time, I'm not saying 100% of the time, most of the contracts, mortgage contract specifies that this particular contract, this particular loan is mortgaged by this particular house and by this particular house owner. Does that make sense? So it's not only a loan that I lended to you, but it also has to be lending to you that is secured by this particular house in the particular situation that you provided me. So if you are trading this house, if you're selling this house, then I'm not going to have this loan continuing anymore. Whether the next person who is buying the house are going to be able to resume that loan, not sure. So most of the contract is going to specify is that in the event of sale or change of the owner, then I will have to make sure that all the mortgages is paid down. That makes sense? So if you sell it to somebody, once it's sold, once the house is sold, then the whole balance has to be paid down. Okay. Like we said, prepayment can be triggered by mortgage rates, dip and defaults, natural disasters. That happens when, say, natural disasters actually destroyed a lot of those constructions and improvements. Then the insurance company come in, and this insurance company is not going to keep paying down the mortgages at a regular pace. So they are going to pay down everything up front and say whatever you owe the mortgage, they're going to come in and pay it down. Home sales, we just talked about it, and there are occasionally some other reasons. For example, you're owing taxes and other things. Okay. So what is that particular effect on the whole trading and the pricing, the valuation of the mortgages? This is very important, because if you have one mortgage and you're looking at this particular mortgage, once it's prepaid, then it's gone, right? So it's either existing or it's prepaid. So it doesn't sound like that important, but when you're talking about a whole pool, that's another story. Because if you have a whole pool of mortgages, there are always something going on. As long as the pool is big enough, there's always some mortgages that are paid down. There's always some kind of defaulting happening, some kind of prepayment happening. So it's very important to look at the whole situation in an analytical way. So let's take a look at it. A homeowner might be reluctant to pay off a low rate mortgage as a part of a move if the current rate is much higher, so leading to a higher cost of financing. This is the lock-in effect. What does that mean? Basically it says, hey, I have this particular house. I know that if I move, then I will have to pay down the current mortgage and borrow a new mortgage. Does that make sense? When I borrow a new mortgage, put out another 30 years, it may or may not be intimidating me. A lot of times it will intimidate me if the market prevalent interest rate is much higher than my current mortgage rate. So say if I'm living a similar kind of size of a house, just because I moved and I buy and sell the houses, then I have to take on a higher interest rate. That means a lot of things could change, right? So monthly payment and all of those can change, and that's going to be putting additional pressure on my personal finance. So they're reluctant to move when the market prevalent interest rate is higher than their pre-existing interest rate. What does that mean? It means to the lender, it's not a good news, because for the lender, when the market interest rate goes higher, that's when they want to go out and lend out new loans. And here are some people, the borrowers do not want to borrow the new loan. So this is when you see that the capital is locked in at a lower interest rate, And if a mortgage is assumable, however, the house buyer or home can take over the mortgage at the existing rate. And when the current rate is high, then buyer seller will find it beneficial for the buyer to assume the mortgage. So if you're kind enough to have somebody to allow this kind of mortgage being assumed, then your money, your capital, the lender's money, capital will be locked in there for even longer, because the seller of the old house owner can be selling the house with this low interest assumable mortgage as an additional feature to attract people, right? So the house owner is the one who actually gets the benefit from this low interest rate, not the bank, not the lender. So what else will affect the prepayment? Well, there could be first of all, if the spread between the contract rate and current mortgage rate is bigger, then there is a stronger incentive to refinance. The level of mortgage rates actually also have it on there, because when the mortgage rate is lower, the houses are more affordable, and then the refinancing of course come up, but also when houses are more affordable, many people would choose to upsize, right, move into a bigger house. That will start some kind of housing turnover, more trading and sales in the housing market. So second of all, what affects the prepayment? Well, historically from research, we also learned that the contract rate, the guarantee, if there's any kind of additional loan feature that has a guarantee in it, the amount of seasoning. What is a seasoning? How many years the loan has the borrower has been into the loan. Does that make sense? So if it's a 30-year loan and this is the 5-year, the 5th year of payment, then that 5 year is the amount of seasoning. Okay, another mortgage that was issued 10 years ago will be much more seasoned or aged than the current loan that is 5 years into it. Types of the loan, of course, and then geographical location of the properties. Why? Because different location actually has different housing market, different sales, so all of those will change. Seasonality also changes a lot because it goes by month to month, and it has a clear seasonality effect. The home buying increases in spring, peaks in summer, and generally declines in fall and winter, right? Part of it is because of the school zones, school year. A lot of people choose to move instead of during a school year. They would prefer to move in the spring, buy a house, then move in the summer, then get settled in the fall. So because of that, the prepayment also begins to rise in spring, peak in summer, and it's fairly low in winter months. Economic activity, if it's clearly a growing economy, then there will be rising personal income, chances for reallocation, and then increased housing turnover. People, when they get rich, they go switch their house to a bigger one. And the opposite is also true for recession. Right, so right now, if we are going to rationally look into the near future, what will happen? Probably not going to be so good, right? So probably we're going to face some kind of recession. Okay, so that is a quick review of individual mortgage and this biggest feature, the prepayment. Well, of course, a mortgage also has a default feature, but the default itself, from the first month of delinquent payment until the end of it, first of all, it has many different outlets, and second of all, majority of the default as a phenomenon or starting of the event will wind up resolve as some form of prepayment, right? So REO, short sale, many of the resolution for a default will wind up having this mortgage being prepaid. So mortgage default by not paying anything, that itself is a small proportion. So default is not as important a feature to study compared to prepayment. And therefore, we are mainly focused on the prepayment right here. Okay, so give me 2 minutes of a break. I've been talking alone too much. I just need a sip of water. I'll be right back. Now we're seriously about getting into the mortgage-backed securities. Okay, so first of all, let's understand what is a mortgage-backed securities in a little bit more detail than just conceptually. So a lot of times the most basic kind of mortgage-backed security, or MBS, we call it a pass-through. Okay, a pass-through. Basically, the pass-through, just as the name is indicating, is passing through all the cash flow that's generated by the pool of mortgages into these investors, the pass-through holders. So the pass-throughs are the claims on a portfolio of mortgages. So who are the ones issuing the pass-throughs? Federal agency, mortgage banker, bank, right? So investment companies, all of those that are able to buy up a lot of mortgages. Right? Additional type include FHA, home loan association, and then VA, the Veteran Association, insured. A lot of those, if they are buying a certain type of the loan, then they most of the time they pull it into a particular portfolio of mortgages. So they hold pools of mortgages and they sell shares of certificate based on the pool. And these shares of a certificate then have the claim on the cash flow that's generated by the pool. So what kind of cash flow that are generated by the pool? Two types, right? Two types. Is monthly what kind of cash flow are generated by the pool? Monthly interest payment and monthly principal payment. Right, so the principal payment is exactly going to pay down towards the pool's overall principal, whereas the interest payment is just paid as a cash flow for the interest. And whenever we have a pool instead of individual mortgages, we now have weighted average coupon rate. Instead of individual yield, now we have weighted average coupon rate, the WAC. Why? Because when you have one mortgage, it's natural to think about the mortgage rate as one rate. However, all of these mortgages cannot be issued exactly the same, right? So they have to be issued towards different person, collateralized or secured by different houses at different mortgage rates. So when you pull them together, its most important measure will be an effective measure will be a weighted average coupon rate, with the weight being the amount of that loan. So if it's a bigger loan, then it will be weighted more. If it's a very tiny loan, then it's less important in calculating the overall weighted average coupon rate. And similar idea, instead of having one maturity, then we could have weighted average maturity. Well, you might ask, well, isn't that all of those mortgages are 30 years? Yes, a lot of times when they make the pool together, they are going to pick 30-year mortgages. But that 30-year mortgages is when it was originally issued, right? When it was originated, they all have 30 years outstanding. But But because of different seasoning, because of different kind of aging of each mortgages, some mortgages have been being paid down in 3 years, and some of the mortgage has been paid down for 5 years, 8 years, and so on and so forth. So the remaining maturity could be different. So here we need to be very careful. There's two different stories. One is the maturity itself. The other one is the remaining maturity. Remaining maturity. So here the WAM then is looking at the whole pool's weighted average remaining maturity. So it's looking at the remaining number of months in terms of a month to maturity for each mortgage loan in the pool by mortgage outstanding. So it gives you an idea on average how old are these mortgages, right? We talked about it before. Why is this aging or seasoning of the pool is important? Coming back is one of the features, right? The amount of seasoning. The older it is into the loan, the longer it is into the loan, the higher the chance it will be prepaid. So if you have a pool of mortgages, on average, this pool is fairly old, then it has a much higher chance to have some kind of a prepayment happening compared to a younger pool. So the biggest agencies the biggest issuers of pass-throughs are Ginnie Mae, Freddie Mac, Fannie Mae. They sound familiar? We talked a little bit about these when we were talking about agency bonds, right? So they are the biggest players in this market. And in fact, this is one of the main missions that they need to do to provide in this kind of a process of buying the loans and mortgages off the balance sheet of the banks. They pull them together and they provide immediate liquidity to the banks. The banks get their money back, and they also provide additional investment opportunity for the investors who want to get access to investment in real estate. And there are also non-agencies like commercial banks, any kind of thrifts, private conduits. You can have a syndicated loan or some other kind of real estate REITs and things. They can also issue some of the loans, right? Ginnie Mae, in all of these, the Ginnie Mae is a little bit different. Ginnie Mae is the governmental sponsored, the GSE, one of the GSE we talked about. They are, all of these are fully modified pass-throughs, and they guarantee a timely payment. So Ginnie Mae is special because they have this additional timely payment guarantee, and it is backed by the full faith and credit of the U.S. government. Right, so these, quickly recall, they are GSEs, government sponsored entities. Right, so there are some others also issued and guaranteed by Federal Association, Rural House Services, or Farmer Mae. As an example, we can take a look at this. Mortgage banker, bank or investment company present a pool of FHA, VA, or farmer FMHA, farmer mortgages, farmer loan, farmer-made mortgages of a certain type. Okay, for example, this whole pool is 30 years, or this whole pool is 15 years, so on and so forth, to Ginnie Mae. If the mortgage pool is in order, satisfy certain kind of criteria, the Ginnie Mae will issue a separate guarantee which allows the MBS on a mortgage pool to be issued as a Ginnie Mae pass-through. So Ginnie Mae issues a stamp. In particular, they're providing this guarantee. They're saying that, hey, I'm going to provide you this particular insurance. And if you give me a pool that's in a certain good quality, I'm going to guarantee this pool so that this pool can be used to issue the pass-through. So that is this type, the special type is called Ginnie Mae pass-throughs. And Ginnie Mae pass-throughs are backed by the full faith and credit of the US government. A second type we can take a look at is the Federal Home Loan Mortgage Corp, FHL, MC Participation Certificate, the PC. So Freddie Mac, they issue PC and Gold PC. The PC is a modified pass-through, and a Gold PC is a fully modified pass-through. So, so the modified pass-through and fully modified pass-through is basically different. The difference is depending on how much is guaranteed. So the pass-through is guaranteed payment of interest principal, but only timely payment of interest and principal paid when collected usually within a specified date. Okay, so I'm going to guarantee it. However, only using a certain range of the date. If I'm able to collect this amount, then I'm going to pass through it. A fully modified pass-through then is a different story. Now it has an implicit kind of structural guarantee and say, oh, as long as you are holding certain kind of trench or certain kind of level, regardless of whatever the collection process or collection situation it is, I am going to pay it to you. So the Gold PC is a fully modified and therefore is more secured compared to the PC. But it has a similar credit, slightly more risky compared to Ginnie Mae, because Freddie Mac, they also have the implicit back, not guarantee from the US government. Right? Fannie Mae, they issue MBS, fully modified pass-throughs, similar to credit as Fannie Mae, Freddie Mac. And there are also non-agency pass-throughs. So the previous one that we talked about, Ginnie Mae, Freddie Mac, Fannie Mae, they are all agency pass-throughs. And there are also non-agency pass-throughs. There's the conventional pass-through, also called the private label pass-through. These are issued by commercial banks, right? So these could include, say, some familiar names: Prudential House, Prudential Home, Chase, Citigroup, right? Some of the, is Ryland still existing? GE is gone, right? GE Capital is gone. Of course, there are additional private conduit pools, but all of those has to be registered with the SEC. Anything to be sold as kind of investment security has to be registered with the ABC. So, of course, these pass-throughs are fixed income type of securities. For fixed income, the way that we estimate and look at the risk, and one very important pointer or benchmark is the rating agency, how they are going to give the rating to all of those. So the rating agencies, they look at the pass-throughs depending on, first of all, what kind of property is in the pool. Okay, what kind of a property is related to that particular mortgage? Are these mortgages all single family, or are these all multifamily? Different type of properties, the risk is different. What type of a loan itself? Is it fixed interest rate loan? Is it non-fixed interest rate loan? Does it have? Is it assumable? All the different kind of features. The detailed loan terms. They're also looking at geographic dispersion of the loans. Okay, so if it's concentrated, then the risk is less diversified. But the concentrated could be also the management of all the property could be a little bit homogeneous, so a little bit easier to estimate. Then you can also look at the loan size, age of loans, and the purpose of loans. The purpose of loans can be, sometimes can be construction loans, sometimes can be buying the existing house. So those purposes are different. If it's a construction loan, you're gonna face a high risk, and that's why it has to be separately negotiated. Right, so if it's a non-agency pass-through, a lot of times these commercial banks, private banks, they also need some kind of external credit enhancement because they themselves don't have enough of a credibility to issue it to the market. And in order to attract more buyers for this kind of security, they are going to have credit enhancement in terms of, for example, third-party guarantee. Right, so for example, they can work with AIG and say, can you provide me a guarantee for the price of so-and-so basis points of insurance premium? Right, so they can also have the letter of credit. The bank, any kind of a bank can provide a letter of credit. They can have a pool insurance where the whole pool is going to be insured from losses, any kind of losses and foreclosures. Then, of course, the prepayment is too often, but you can still be insured from defaults and foreclosures, Bond insurance, right? So like CDS can be used as a supplement. It can be internal, okay? So just by the way that you operate this particular pool, internally, you can set up kind of like a defense feature, this defense structure in order to provide some kind of a credit enhancement to make it sound, at least make it a lot safer, less risky. You could have a reserve fund, right? So you can have a cash reserve fund, you can have excessive servicing spread, so that you can deposit part of the cash from the issuance proceeds whenever I issue it to the market, the pass-throughs, I sell it in the market. I deposit part of it in order to save it for a rainy day. So that it is lowering the cost, lowering the risk. Excess servicing spread, I could be allocation of excess spread or cash into a separate service reserve account after paying net coupon, servicing fee, and expenses. I'm going to talk a little bit more later on, because when these entities, they issue pass-throughs, these banks, they issue pass-throughs, of course they are not issuing for free, right? So they have to charge a service fee. So they are going to allocate part of those revenue on the side in case anything happens. That's the main idea. They can also have an over-collateralization. What does that mean? So basically, they're trying to make sure that the principal of the mortgage pool is much bigger than the principal of pass-throughs. For example, I have a mortgage pool of, say, 500 million in total. And then when I issue the pass-through, the sum of all pass-throughs sum up to be 300 million. So that way, I'm over collateralization. So I try to guarantee that there is more than enough assets that's backing up whatever I'm issuing. It can be also done in a way that is having a senior and subordinate structure. Okay, so subordinate classes, these are the first ones to absorb the losses. And with that kind of protective structure in there, then the senior structure, the senior trenches will have additional protection. And that is not from external kind of a line of credit from third party, but rather provided by the internal different structuring. You can also shift the interest. Right? So the shift interest structure will then redirect the prepayments disproportionately from the subordinated class to the senior class according to a specified schedule. For example, to have enough insurance to cover losses, and also in default fast prepayment period, a subordinate portion may grow after riding up the yield curve. So what does that mean? Well, in some period, there is not much of a default, but a lot of prepayment. So, of course, prepayment is also not welcome by the that's not also not welcome by all of these trenches. So, who is going to get their money back early? That is a question of the structure, right? So typically subordinated portion, they are going to be covering the losses. If there's a default, then the subordinated portion, of course, they are going to be sacrificed first. Is not enough money not enough cash flows handed in, then any kind of losses will have to be absorbed by the lower trenches. But when there is prepayment, a lot of time is the senior trenches who get the money first. But in that case, when the senior trenches don't like it, the subordinated portion may actually grow, right? Because the senior trenches has been really paid down. The subordinated trenches are going to be riding up the yield curve, because we look at yield curve. When it gets to so let's look at the yield curve. This is a 1 year remaining, like 5 year remaining, 10 year remaining, and any kind of term, say 20 year, 30 year remaining. So are we going from these interest rate towards this direction? Are we going from this interest rate towards that direction? So to the right or to the left? It's typically going to go to the left, because the remaining maturity will get shorter and shorter. No problem. Good try. The remaining maturity will be shorter and shorter. So if you're looking at a yield curve, it's gonna get to the shorter side, shorter term of the yield curve. So it's gonna go down. However, in this particular case, if there is a lot of prepayment and not enough default, because the prepayment is going to be absorbed be taken by the senior trenches, and the default is taken by the subordinated trenches, then overall, the proportion of the subordinated proportion will actually become more and more in a weight. Does that make sense? We have a whole pool of senior and subordinated. If there is no prepayment and only default, then the subordinated is going to be taking the hit. Right, so that is going to take the slash. But sometimes when there's prepayment, the senior tranches actually got their money back early, just to make it safer. So the senior tranche is going to take their money back early. In that case, if we take a look at the remaining, the proportion of the subordinated may be a little bit bigger. In that case, because subordinated tranches typically have higher yield than the overall weighted average of yield or weighted average coupon rate will become higher. So that's what we call riding up the yield curve. Okay, just like any other kind of fixed income market, we have the primary market, we have the secondary market. The secondary market is mainly over the counter. The primary market is issued by whoever issuer it is. There's details. And let's take a quick break of 10 minutes and we come back to take a look at the cash flow analysis.